Hi, my name is Malcolm Pengelly and I'm a member of BDO's Tax Support for Professionals team. Welcome to our webinar on incorporation of property portfolios, being one of 4 webinars in our Property Tax Update series. BDO TSP provides tax advice to accountants and other professional advisors from our long-established and market-leading team. For more information on our services, including joining the mailing list for our free e-zines, please visit www.bdo.co.uk/TSP or call us on the numbers provided at the end of this presentation. So we're frequently asked on the tax line, why should I incorporate my property business? Well, here are some reasons. Limited liability of company ownership might be important to you. Corporation tax rates, soon to be 17% from April 2020, are much lower than up to 45% in personal ownership. There's no interest restriction in a company if the interest charges are less than £2 million, but we'll talk more about interest relief restrictions later on. If the family doesn't need the cash, then the income can roll up at corporation tax rates in the company and be used for future business and reinvestment. Some individuals use a company as a family investment vehicle. It keeps valuable assets away from the children and allows the parents the flexibility of when to distribute funds out to their children. Those were the good points. What are the cons? There could be a significant tax cost to incorporating, and those 2 liabilities are likely to be capital gains tax and stamp duty land tax. There could also potentially be a double tax charge on the sale of a property, once to corporation tax on the company's sale, and again when extracting the cash out into personal ownership. That could be an effective rate of 35.2%. Compare this with 20% or 28% if the assets are held personally. Importantly, there are reliefs that can be claimed, particularly from capital gains tax. How sure are you that your clients can claim those valuable reliefs? What does one need to do in order to make sure they are in a position to claim? I thought that in order to demonstrate the difference between personal ownership and corporate ownership, an example would be useful. And so here is one. We can see that in 2016-17, the first left-hand column, the client was left with net cash of £12,000 in 2016-17. By the time we get to 2020-21, the far right-hand column, he's actually making a loss of £8,000. This is certainly driving people to think about incorporating their property rental business solely on the back of the restriction for interest relief. And we're seeing more and more property businesses incorporating as we get closer to April 2020. Let's compare the numbers to company ownership. Again, we can see that for 2016-17, there's net cash of £10,800 in the left-hand column. That's slightly less than the situation was under personal ownership, where the cash in hand was £12,000. But by 2021, net cash of £11,205 in the far right-hand column will become a loss in personal ownership of £8,000. So incorporation is saving £19,205 per annum, not an insignificant amount. So how do I avoid the upfront tax charges of capital gains tax and SDLT? Well, let's look at capital gains tax first. The starting point is that all properties are transferred at market value. If that market value is in excess of cost, then a taxable gain will arise. This can be substantial if the properties have been owned for a long time. However, there is a valuable relief called CGT rollover relief, statutory references in section 162, Taxation of Chargeable Gains Act 1992, and this enables the gain to be rolled over. However, its use is restricted and it's only available where what is being transferred constitutes a business. The issue with property investment portfolios is, are they a business or are they just an investment? A recent case which considered this was the case of Elizabeth Moyne Ramsey, who was successful in arguing that her business, which comprised the letting of a number of flats, was sufficient to comprise a business. The points that made this particular endeavour a business was it was a serious undertaking, earnestly pursued. She pursued this occupation continuously for a number of years. There was substance to the business in terms of turnover and the time she spent carrying on the business. It was carried on in a sound and business-like manner with a view to profit, and she spent 20 hours per week actually running the business. This went beyond mere passive investment of properties. So, if you can meet the conditions in section 162, the gains on the properties are rolled over into the base cost of the shares, and there is no immediate tax charge on incorporation. So let's move on to SDLT. Again, the starting point is that the transfer of the properties to the limited company will be a transfer based on the market value of the properties at the date of transfer. This could be a substantial amount of SDLT. However, special rules apply where the business that is being transferred is carried on by a partnership. In this case, there may be little or no SDLT to pay. The legislation is complex and needs to be considered on a case-by-case basis, indeed a property-by-property basis. The key points are: properties must have been acquired by the partnership and SDLT paid by the partnership, not transferred in by a partner or partners. It goes without saying that the partnership needs to be running a business. There also needs to be at least one individual partner. Okay? A partnership of corporates will not qualify. Some commentators also say that SDLT must be physically paid by the partnership. If we can't take advantage of the partnership provisions, let's think about whether we can reduce SDLT by other reliefs, such as multiple dwellings relief or the transfer of 6 or more residential properties. We've looked at the capital gains tax and SDLT opportunities. What are the practical issues? Well, a commercial lender may not be willing to lend to a company. They might require personal guarantees. They might charge a higher interest rate or an arrangement fee. All these costs need to be weighed up in the round when considering whether it is efficient to incorporate. A common problem is what to do with mortgages on the properties. HMRC set out their position in extra statutory concession D32, and it is important that one follows the Inland Revenue's guidance therein. Otherwise, failure to do so could mean that some or all of the gain crystallises on the transfer. Not all lenders realise the nuance of how the mortgage lending should be transferred, and it's important that they understand that this needs to take place by way of novation. One should also not forget that there are likely to be increased administration costs of running the company, and that will be a year-on-year occurrence. Finally, there are some things that we are hearing out in the market. We've heard suggestions that all you need to do to avoid a stamp duty land tax charge is to form a partnership, pop the properties in there, carry on a business for a little bit and pop them out. HMRC are well aware of this, and there is SDLT anti-avoidance legislation which is likely to be applied, and you may not therefore avoid the SDLT charge. Another suggestion is let's just transfer beneficial ownership of the property to the company. Is this sufficient to get Section 162 rollover relief? Some people forget that the transfer of the beneficial interest is also something liable to SDLT. So you may get within the capital gains tax holdover relief, but end up with an SDLT charge. It's also complicated if a mortgage is in place, because it's likely the bank is interested in legal title, whereas the beneficial ownership will be with the company. You may need the lender's permission. And finally, there have been suggestions that why doesn't the individual lease the property to the company at below market rent, thereby paying less tax at 45% and more tax in the company at 17% and 20%. Again, there is anti-avoidance legislation which may well mean that the rent gets imputed back to the individual and taxed at 45%. This concludes our webinar on incorporation of property portfolios. If you'd like further information on tax support for professionals, please call the numbers on the screen now or visit the website. You may also be interested in our LinkedIn group, and if you'd like to join, please send my colleague Chris Holmes an email at the address shown on the screen.